Everybody, welcome to the Sherman Show. I am Jeff Sherman along with my co-host Sam Lau.
Hey, hey.
And today we have a very special guest on our second episode of 2022. Lots of twos here on a Tuesday, nonetheless. We have Alexander Altmann. We call him Alti because, we're all friends around here. He's an MD, but more importantly, he's the head of equity trading strategy in the Americas at Citi. He's responsible for equity macro, thematic, cross-asset, derivative idea generation, technical analysis, you name it, he does it, hence the Alti toolkit. So welcome, Alti.
Very much. Thanks for having me, guys.
Yeah, thanks. So, we'd be remiss if we didn't start talking about, all of the inflation data, what's been transpiring with Fed policy. But before we set all of that, why don't you give us your current thinking on what the current economic landscape is? The stagflation word's been thrown around a lot. The bears are out there saying how, there's a lot of recessionary indicators. As someone who's trying to build equity trading strategies, what is your current thought about the economic landscape?
Well, look, to keep it pretty simple, I think the current economic landscape is, if you're going to make like these bold predictions, several quarters in advance, I think that's become an occupational hazard in the 21st century. If you think about, say, everyone came into 2020 super bullish, if you remember, whoops, pandemic, even though, by the way, the yield curve was inverted, and yet no one seemed to pay attention to that at the time. And then everyone came into 2021 with this narrative of transitory inflation, and whoops, that didn't turn out so great either. So, I think that sort of trying to predict the economic landscape too far in advance is becoming an increasingly challenging exercise. But with that being said, massive caveat, I think it's pretty fair to say that actually growth is slowing, but that's not a scary term. Growth was running at a 9% annualized clip rate in the third quarter of last year. So, if we normalize to even 3%, it's clearly a 600 basis point slowdown, but it's still above, long-term trend. So, growth is slowing, but, you've got 7 deciles of the consumer still doing in pretty good shape. Financial conditions are still amongst, if not the loosest we've ever seen them. The Fed are still buying treasuries, for goodness sake, at the time of this recording, right? So, I think we also need to put into context that, it's easy to say ahead, 1, 2, 3 quarters that growth is going to slow, but I would definitely stop short of saying stagflation at this juncture because, from what I can tell, the economic outlook actually looks all right. And yes, we could definitely look at the Eurodollar curve and say, all right, well, there's pricing in rate cuts in 2024, and there's howls of protest that there's going to be a policy error imminently, and the 530s curve 1 year forward is already inverted, and all this kind of stuff. It's like, all right, but we need to trade what's in front of us today as well. Cycles are getting shorter, holding periods for stocks are getting shorter. And on that basis, I actually think the economic outlook based upon the consumer, corporates, the backbone of the US economy is actually okay. One final point as well, everyone's howling about high oil prices. Come on, $95 oil in the context of, say, where we dealt with $100 oil for 3 years between 2010 and 2013 or whatever it was, and no one complained then. $100 oil in 2022 money is more like $85 oil today. So, I'm not really particularly concerned about oil prices crimping the consumer just yet. So, economic outlook, I think it's okay. Slowing, it's all right. We should be slowing. We've had a long period of big economic expansion.
What's interesting about all of that is, I've been talking to a fair amount of our clients recently, and they've shown some trepidation about this Fed policy. And, talking about policy error, the big pushback I've heard is that, well, the Fed's going to hike this year. And I listen to Fed governors, they may hike like 5 times, 6 times. In there, and you got Bullard out there talking about the 50 basis point hike. Again, mind you, they're still buying bonds today. It seems kind of weird to want to hike 50. Why don't you just stop buying the bonds? But anyway, that being said, what I like to remind people is that don't forget the yield curve or the euro dollar curve already has 6.5 hikes priced in this year. So anything below that is actually accommodative policy because we've already got there. So that leads me to my question to, when we think about the Fed, we saw this kind of visceral reaction of the U.S. equities when we saw the first repricing of these Fed hikes. But the last, kind of hike and a half or so, it hasn't really been as negative for equities. So what do you think about when you're thinking about the Fed? What do you think about the policy? And how does that impact how you're thinking about the U.S. equity market today?
this is the question, right? So there's only two things we're trying to solve for. We're trying to solve for the pace of financial tightening, and we're trying to solve for the level of inflation, right? And so you're obviously highlighting one of them, although they're arguably both intrinsically linked. I'm not worried about the Fed hikes. That doesn't bother me. As you said, we've got a lot of hikes already priced in. Equity market has digested those reasonably well. It's the other bit that scares me. It's the fact that they haven't even started the hiking process yet, but they already want to talk about quantitative tightening, right? So the sequencing, in my opinion, is the scary bit. And we saw in 2018 that there was difficulty and indigestion of the economy to handle simultaneous rate hikes and balance sheet shrinkage, right? And although the Fed haven't done anything today, we've already discussed they're still doing QE at this particular moment, it's very easy to envisage that we could get to July, August, when they've already begun, hypothetically, not only rate hikes, but also balance sheet shrinkage. And all of a sudden, we're looking at a path of financial tightening, financial conditions tightening that is undesirable or overly tightened. And we've done some work on this. We've actually looked at periods between 2013 and 2017 when there was a big balance sheet expansion. And then we looked at the balance sheet contraction in 2018. And then we looked at the balance sheet expansion again in 2020 and 2021. And what we found was there's actually a very consistent empirical and quantitative evidence of changes in balance sheet have a linear impact on changes in real yields. All else being equal. So if you strip out the effect of actual overnight rate cuts and hikes and whatnot, well, we haven't seen any hikes, right? But so the point being that for every $100 billion of balance sheet shrinkage or balance sheet expansion, it equates to 3.1 basis point change in real yields. So down and up.
Yeah, but 3 basis points, not 30, not something crazy. You're talking about 3.1 basis points.
3.1 basis points. So if you sort of extrapolated what, for example, Citi economics team are forecasting that between July of this year and January of next year, $450 to $500 billion of balance sheet shrinkage. So you're looking at 12 to 15 basis points increase in real yields. That's in excess of what the hikes will do, right? But remember, you can dial that up very quickly. And if you're talking about, say, $1.5 to $2 trillion of balance sheet shrinkage per year, then all of a sudden you're dealing with a real problem in getting real yields up to a very elevated level that I just don't think the economy can handle. So hikes, Fed policy in that regard, I've got no issue with it. Like, bearing in mind, where was base rates before COVID hit? Like, 2 and change, or whatever it was. We've got a long way to get to even that number. So, but if you throw in QT on top, that's where I have a bit more of a problem, because we're already at neg 45 and 10-year reals. And if you throw in a good dollop of QT, you could very quickly get to sort of neg 25 or even 0. And then I think, financial conditions will be considered relatively tight, and the equity market will struggle.
Yeah, what about the concept? Because I have a very similar thing that I feel that the rate hikes, we understand that mechanism. You're looking at like a sample size of 1 when we talk about QT, really in any meaningful size, right? There's been kind of that natural attrition over different periods. But, as you start to think about this, I've had a lot of folks come to me and say, well, the difference now is that the Fed can do more. They can unwind more of the balance sheet via QT because the balance sheet is larger. I take pause with that because I'm like, it's marginal dollars at the end of the day. I think that's what you're telling me as well. But what is the Fed's hurry in trying to unwind the balance sheet? If you recall last time, it took them 3 years or so to really get around to doing it. And then it took them like a year and a half to get towards a meaningful size. And by that time, yes, it kind of crushed risk assets. And again, it was that impact of real yields. But what do you think about it in this round? What is this eagerness of the Fed to want to do QT so quickly?
Great question, Jeff. I have no idea, because, if I was,
it just seems aggressive, doesn't it? It seems aggressive to me. Like, why not go through the traditional mechanism? Let's do it. Give it 6 months, because there's trillions of dollars. We have a $9 trillion balance sheet, right? So 9 trillion.
Yeah. Just, it's literally Dr. Evil numbers now. It's just
you gotta do the finger thing.
Yeah. And Do you know that look, it's what I can't get through my head either, because, you know, coming into this process where we knew there were going to be rate hikes, as you just asked the question, you know, how do I feel about them? I feel fine. I just don't think there's any issue. You know, we're coming from such a loose financial conditions environment that, you know, rate hikes should be happening. I wrote a piece last August saying there is such a thing. There's so much. It was called Too Much of a Good Thing, right? Where ISM was peaking. Typically, that sort of coincides with changes in financial conditions. And ISM had already peaked, but financial conditions were still loosening. I was like, this makes no sense. So finally, we're getting that normalization. But so why are they doing QT? And I think there's a very simple answer, and it's just a guess. It's that they are absolutely petrified of losing credibility with this prevailing level of inflation. And by the way, I don't think they've lost credibility. I think that, you know, that Powell has perhaps been thoroughly wrong-footed by the sequencing of, you know, a simultaneous supply and demand shock coupled with massive monetary stimulus and fiscal stimulus. And we are now left with a lingering inflation problem. But if you actually look at, for example, the forward inflation curve, it doesn't look massively untoward at all beyond the 1 year point. However, I think that the Fed are spooked. And so they are trying to course correct a supertanker right now, and obviously run the risk of overcorrecting at the wrong time. So the analogy I'm using is sort of one of resonance, where, you know, if you're in harmony on that frequency, just the amplitude gets bigger and bigger and bigger. And that's kind of, I feel like, what we're the environment we're in right now, where the first course correct was COVID and then massive stimulus. Then the second course correct was fiscal stimulus, and then you had this supply shock, which then led to, you know, your first round of inflation. Then you had this, okay, it's transitory, no worries. And now all of a sudden we've got this, you know, Chair Burns 1972-esque, well, actually, if we strip out all of this stuff, it's still fine. Uh-oh, no, hang on a second, it's not really. So I think there's now this degree of overcompensation. But the problem is that, and this is the mistake that they made in 2018, is that your monetary base is expanded. So and the economy sits on that monetary base. You can't just suddenly shrink it down. That's akin to having one of those, you know, massive Jenga towers where all the pieces have already been taken out, and you sort of haphazardly, in a drunken fashion, try to put one piece back in. It doesn't work like that. You end up sort of just knocking the whole thing over. So that's what happened in 2018. We sort of teetered. And today, I think we're left in a similar situation where I think the Fed will very quickly realize that trying to do QT will have very undesirable consequences for risk assets.
So there's this about face, somewhat this change in course, let's just say, that we've had over the last 3 to 4 months out of the Fed, and the seemingly aggressive talk that's come, you know, that's accompanied some of the forward-looking guidance there. Does this kill the notion that many have had since the global financial crisis, and, you know, even predates that, the idea of the Fed put, you know, the Greenspan put before, you had the Bernanke put, you know, the Yellen put, and then now, you know, the Powell put. Is it still in play? We see a lot of pundits out there saying that they're going to abandon the idea of the Fed put because they are scared of inflation and because they're trying to be more aggressive with the path of policy moving forward.
This is a great question, right? The Fed are left with no good options here, right? So they either try and tame inflation, which may or may not subside on its own. We don't know. The tools, the quantitative framework that we use within my team to try and make the assessment about whether inflation is going to, you know, naturally erode, hasn't given any indication so far that it's going to materially decline. So on the assumption it doesn't decline on its own and the Fed need to react, they're left with no good options. So they either hike and tighten financial conditions and at the expense of the equity market. So as you say, the Fed put has gone because there's a credibility at stake, or they hike, but not overly aggressively, hope that inflation naturally moderates down to a more reasonable level. But actually, secretly, is the Fed comfortable with running, say, a 3% inflation target to naturally erode the size of that balance sheet in real terms over time? The problem is that if they can't get real wages positive in doing so, then the other problem is the consumer gets crushed. Right. And you end up with a far bigger problem, the S&P going down 20%. You end up with a problem of guys in streets with pitchforks and torches. And so, there are no good options. Either way, that the consumer's going to get hurt. Disposable income will get hit if risk assets drop precipitously from tightening financial conditions, or the consumer gets hurt because they can't afford the basic necessities, rent, food, heating and energy costs and transportation costs, basic stuff, Neanderthal stuff that we need to live. So, this is a terrible time to be a central banker. You aren't left with any good choices. And I know which one, I think I know which one I would choose, but, I'm not a central banker. Thank goodness for the world, I'm not a central banker. And, back to your question about, is there a Fed put? I think that ultimately it will always be a Fed put, because we know what happens, that there's such an interconnectedness between the financial economy and the real economy now, that a precipitous drop in risk assets. I mean, the buzz phrase is the S&P is America's ATM, right? So if you had I'm just plucking a number out of the air, if you had a 30% drop, sustained drop in the S&P, that's really bad. It's really bad, not just because lots of people lose money. It's really bad because in itself can trigger a recession. And so, I don't know how the Fed are going to be able to thread that needle, but I do know, back to Jeff's point about QT, I'm reasonably convinced that embarking upon an aggressive QT program will have undesired consequences. I mean, Einstein said it best, right? I know we only have a data point of 1 with 2018, but Einstein said insanity is doing the same thing again and again, expecting different outcomes. Why should we expect a different outcome in this particular episode of quantitative tightening?
Yeah, it's the old phrase too, this time is different, right? It's like the yield curve doesn't matter, QT doesn't matter. It's kind of wishful thinking. And you said it best, it's kind of hope. And a wise man once told me, hope is not an investment strategy. And it's not very good guidance here either. But, you talked about a sustained level of inflation. And I look at like zero coupon swaps today, 1 year rates, 4.30 on inflation. Sure doesn't sound like the Fed's 2%. Like, okay, CPI is different than PCE. We can throw 50 basis point discount, whatever. I don't care if core CPE is coming in at 2. If CPI is running at 4, that's what the consumer feels, right? And so when you think about that, and you talked about the potential for there being a different inflation rate. And that's one thing we've been throwing around is like, why wouldn't the Fed just say, you know what? There's nothing wrong with a 3% inflation. 2 is an arbitrary number. Right? What's the difference between 2 and 3? Yeah, compounding, it does something. But, do you see the Fed just eventually saying that, like, hey, we need let's go back to what we called nominal GDP target. Remember this phrase, right? In GDP was what we're going to do. And my sense on in GDP all along was because you have real growth plus you have inflation, right? So it says, hey, we're willing to accept some level of inflation as long as in aggregate, it gets us to our real growth targets. Do you think that potentially the Fed comes back to that mantra, or is this that they're just going to be, so much of just living in the past and saying, we stuck to this mandate, it's what it is, we have to achieve that objective?
Again, this is another reason why I'm not a central banker. Thankful for risk assets that I'm not. Look, I mean, you guys will remember the history lesson. The 2% inflation target came from a very obscure set of comments from all places, the Central Bank of New Zealand, right? And that was whenever it was, I want to say 20 years ago or something. And they just were like, yeah, we think that inflation should be at or around 2%. Everyone went, oh, that seems like about the right number. But the odd thing is that, and so 2% became this holy grail number but I think actually it's kind of chicken and egg. If you just look back at inflation over very long periods of time, basically in the Bretton Woods era, outside of the 1970s, generally inflation has been at or around just above 2%. So you could say that, central banks have largely done a decent job, but again, have they targeted 2%, or is that just naturally where things end up shaking out when you take in sort of highs and lows? I don't know. But should they be targeting 3%? That's your question. And look, the Fed, and this is just one man's view, the Fed, in my opinion, will not admit that they made a mistake, right? And regardless of whether you're listening to watching this podcast and believing that they did make a mistake or not is irrelevant. But if you're running with 7% inflation and you're targeting 2%, you've kind of done something wrong.
And you're still buying bonds. You're buying bonds in size. Like 3 months ago, they were still buying 120 billion a month. I mean, and then they're scratching their head. Why isn't it transitory, right?
Yeah, very strange. I can't quite get my head around it either. But like, I guess what I'm trying to say is that if the Fed at this juncture aren't going to admit that they made a mistake, then it's very unlikely in my eyes that they would abandon a 2% inflation target and formally set a 3% inflation target. What they may well do, and again, this was why, back to your point about QT, why do it? I don't understand why they would explicitly say anything at this juncture and just quietly abandon it and target 3% because it helps out the balance sheet, right? Like, yeah. I just want to draw a slight parallel to your point about, implicitly targeting 3%. If you targeted 3%, and to your point about compounding, over 10 years, that basically gets your balance sheet to where you want it to be.
Right.
Now, obviously, you're going to have recessions during that period in between as well, which may change the balance sheet. But the point being, all else being equal, it does what it's supposed to do. And the same applies for corporates. In a higher inflationary environment, levered companies should outperform. Not those with massive credit stress. And again, there's a caveat that if we go through a credit cycle, levered companies will suffer. But ceteris paribus, in an environment, if the economy grows, just chugs along, or nominal GDP targeting, and you don't have a full-blown credit cycle, leverage works in your favor because your assets grow with inflation, your liabilities shrink with inflation, your equity basically expands to make up the difference. And that's empirically proven going back to the 1970s. And this is what we've been using over the past year and change to illustrate the point that the equity market has repositioned itself in favor of a pro-inflationary environment, was a lead indicator to suggest that inflation was coming big time. And is even today suggesting we're not going to get this big decline in it. So back to your question in terms of, are the Fed going to explicitly target 3%? It would seem very unlikely that they would abandon their 2% target. However, I do think that we will get cues from the equity market as to whether the Fed is succeeding in targeting an above average inflation for a protracted period of time, which would continue to benefit levered companies. And so far, that would appear to be the case.
Yeah, so on that front too, so you're saying look to the equity market. A lot of people say, well, the smartest guys in the room are the bond guys. And again, it's not because we're sitting here working around a lot of fixed income, but my question with this is that a lot of times credit spreads leak wider first, and they show signs of market stress prior to the equity side. And so, we talked about being dismissive of some of these indicators out there. What do you make of the recent weakness in credit spreads, whether it's IG, whether it's, the high yield market, bleeding over to EMD as well, emerging markets? How are you thinking about that? And is this just really a repricing of real yields? Or is it a harbinger of, policy error, too fast, QT, all of these other things?
Again, great question. So there is definitely a duration component to what we've seen within credit spreads. So the biggest problem with credit going into this bout of widening is that typically when you get this point in the cycle, you start a hiking cycle, is that, your duration component should sell off, but which should be offset and compensated by a tightening of credit spreads. The problem is we came into this point of the cycle with both yields ultra low and credit spreads super tight, right? It was the everything rally, as some of my colleagues have mentioned before. And that unfortunately has left credit with only one way to go. There's no cushion within the credit spread itself. But that being said, if you look at for example, the decompression component within certain tranches of credit, they haven't really moved at all. If you look at, say, consumer credit, delinquent loans and whatnot, ticked up from ultra low levels. So there is definitely a small amount of genuine credit spread widening, but the majority of it appears to be a duration component, i.e. just a rates move more than anything else. And that gives me a degree of comfort. Again, back to your original point in terms of, what's the state of the economy? If the economy is still going to grow at 2-3% this year, then it's probably a little premature to be calling, the canary in the coal mine about a full-blown credit cycle taking place. But I do think that, ultimately the modified duration of high yield credit is 4 years and change, but IG is more like 10. So unsurprisingly, IG has underperformed high yield, but everyone focuses on high yield being like, oh no, we're getting this massive credit cycle happening. I'm like, is it? Or is it just the fact that we've had a material real yield move that is going to affect all parts of the duration complex, regardless of whether it's developed market bonds, IG, high yield, or indeed, as you say, emerging markets?
That's helpful, Alti, in framing the conversation, the way to think about equity markets as well. So with that in mind, what is your current view on the U.S. equity market right now? Talking about some of the recent performance that we've had, even just on a short, again, arbitrary window of, let's just say, year to date, it has a number of participants in the market taking some risk off the table. But if you can frame it from your near-term views, I mean, there's a lot of uncertainty based on the Fed monetary policy, central bank monetary policy that we've been discussing. There's been some geopolitical risk out there. But then also in the long term, some of the things that we've talked about is, positive but slowing economic growth, perhaps elevated inflation impacting it. How does this all wrap up into the way that you're thinking about the U.S. equity market today?
I'm gonna apologize in advance for making this overly simplistic, but I try. I mean, my brain is small. My head looks really small in this camera, by the way. So, like, I think it's reflective of my small brain. So,
don't worry, my head looks big, and it's nowhere near the size of my brain. So don't worry about it.
Your hair is magnificent, though. So
Thank you.
So right, let's break. It's just two parts, right? So, U.S. Let's just focus on U.S. equities to keep it simple. There's only two parts. There's the P and there's the E, right? That's it. And we can talk about all other factors, but ultimately it's either the price or the multiple that drives the equity market or the earnings. And in the long term, we all know that earnings really matter, right? Now, we've already talked about the economy. We've talked a little bit about corporates and credit spreads. We've talked a little bit about the consumer. And, barring some exogenous shock or, down the line, we can talk about potential recession risks and whatnot. But as it stands today, earnings look okay. All right, we haven't had a massive upward revision momentum to say the Q1 guidance, the last set of results. And if you look at the broad earnings revisions in the market, they are definitely slowing. And so that is the case of, economic momentum is also slowing, as we've already discussed. So, but for the most part, earnings are okay. Okay, so it's not the E that I'm worried about. It's the P. It's the multiple, right? And this is the simple bit that I mentioned before when I talk about the equity market. I'm worried about the fact that the market multiple will struggle in an environment of both high inflation, as we have empirically proved going back to the 1950s. When you have inflation above a certain demarcation line, the equity multiple will compress. And similarly, as real yields go up / financial conditions tighten, the equity multiple will compress. I like to call real yields the PE break. And given the fact that you have two parts to the equity market, you have your value part and you have your growth part. The value part, the multiple over time has done that. And the growth part has done that. And basically, the growth part in terms of that multiple, which has driven a lot of the S&P re-rating, is very closely correlated to the behavior of real yields. So
yeah, and just for those that are listening to audio, you couldn't see his hands, but he's saying value multiples were flat and growth multiples were on an upward trajectory. So just for our either visually impaired listeners or those that are not watching us on the video.
So yeah, and so it stands to reason that the market or investors are now going to go through a process of understanding the regime shift that the Fed are currently in. And we don't know how long that new regime is going to be around for. We don't know how long the Fed are going to or be allowed to tighten financial conditions. But whilst they are, it is a reasonable assumption that there will be pressure on that growth multiple and therefore the broader market multiple. The good news is that if you still think earnings are going to grow comfortably in 2022, and again, to my earlier point about long-term projections being fraught with difficulty, so I don't want to make any calls on 2023, but for the time being, it's, the earnings will help us grow out of that expensive multiple. That's exactly what happened in the early 90s, by the way, but it didn't happen, for example, in the dot-com bust. So dot-com bust, perfect example, very shallow economic recession, profound market multiple contraction. And, that's probably the best parallel that we've got today except this time, unlike the dot-com bust coincided with the end of the tightening cycle, we're now having to deal with high multiples at the start of a tightening cycle. And as you highlighted already, we've already had a lot of rate hikes baked in, but we still are going to have tightening financial conditions because we're just still at very, very loose levels. So it's the P I'm worried about, not the E. Where are we trading right now? We're trading on about 23 times trailing. If you just run a regression against both real yields and against where CPI is, we should be at the very least more like in line with the long-term average, 19 times in a post-GFC world. That would sort of take us down, obviously, a few turns from here. You're looking at anywhere between 3,800 and 4,200. So there is downside. It's not like cataclysmic downside in the equity market. It just means that US equities as an entirety, as a complex, just not that interesting. But there are some fantastic pockets within it. And that, I think, is what, again, investors are trying to grapple with right now in terms of which part of the equity market is going to give me that protection. And unsurprisingly, it is going to be that sort of pro-value and sectors and style factors that have a positive beta to both rising yields and nominal and real yields. That's
right,
my view.
Yeah, so on that note too, and I'll let you come back to that exactly on what some of those trades and ideas are. But as you think about this too, we're talking about rising real yields. We're talking about probably even more hikes getting priced in ultimately, because what I've seen in the euro dollar curve and extrapolating from the 2s and 5s is that we didn't really change the terminal rate or how far the Fed goes. It's just that what we've done in the last 6 weeks or so, or 8 weeks, really, it was really since the Fed meeting in December, is that we pulled forward the hikes. It's not that we're saying, oh, they're going to make it to 3 or 4% on Fed funds rate. It's still the market's still second guessing that 2.5 that we got to in the last cycle, which is strangely now the Fed's estimate of the long run rate. We'll see what we get on the March SEPs, right? But as you think about it, that says there's probably a little more pain in the bond market, and people are used to trying to use stocks and bonds together. So if you're thinking about, potentially a little bit of downside in multiple compression while we wait to grow out on the E side of the equation, what do you use to kind of offset some of that risk? Because potentially that natural asset class, or at least the one we've gotten used to over the last 2.5 decades, was the fixed income market. What do you think about it today?
It's a problem for risk parity. And that's why you've got a natural decline in risk parity leverage. I think exactly because that this model is going to be a challenge to overcome. So where's the natural home for money? I mean, everyone always asks this question. Is like, okay, if I can't put it in here, where do I put it? Well, at the moment, you're still getting money going into the equity market. I mean, if you go look at the fund flow data, which is well publicized in recent weeks, we've had significant amounts of equity inflows that have still moved from the sidelines from cash and money market funds into equities. So there's clearly still an appetite, because if you just look at people will cite the equity risk premium being elevated, or the earnings yield is still very elevated. But the problem is it's all a bond trade, right? It's all very well saying, well, equities look really cheap in the context of bonds. I'm like, well, what if bonds are just more expensive and going to get cheaper? So you raise a really good point. It may, for example, explain why crypto hasn't sold off as much, because there is a perception that, albeit a relatively small asset class by comparison to the fixed income and equity markets, is a perception that is an alternative asset where I can find a store of value. I have no view. For the record, I can't possibly comment on crypto, but that's just one potential narrative. The other one is, of course, international equities. And this is a bit of work I've done repeatedly over the past few years to sort of highlight that international equities have been almost this elephant graveyard from the US investment community repeatedly for the best part of a decade. And we've become so strongly conditioned that the US equity market is the not just a market of alpha or beta, or whatever you may call it, but also exceptionalism. When in truth, that hasn't always been the case, right? In fact, if you go back over the past, say, 50 years or so, it's quite clear that there's been these decade-long cycles of both outperformance and underperformance of the US equity market. 1990 to 2000 was US exceptionalism. 2000 to 2008 was actually non-US exceptionalism. and the past 10 years, the other way around again. So are we entering a new 10-year cycle where the investment opportunity is actually more attractive on a non-US perspective? And I want to give you a cool stat for this. The US equity market accounts for approximately, give or take, 60% of MSCI World. I think it's the exact numbers is around about 58, 59%, but let's just call it 60% to keep it simple. But it only contributes around about 48 to 49% of profits. So it's around about a 11 to 12 percentage point differential between, it punches above its weight basically. And that is pretty uniformly redistributed in the other direction amongst all other international equities. So EM, Japan, Europe, UK, and so on and so forth. So that has gradually got wider and wider, that gap over the past decade or so. And so there is an argument to be made, not so much that the US is no longer going to deliver on profits. It still delivers almost half of global profits. But do you start to see that normalize back to more towards in line with its profit contribution? And it gets that market cap gets redistributed into other parts of the world. Now, it's just a hypothesis. And if it does come true, the chances are we'll need to have a podcast in 5 years' time to see if it's worked out correctly or not. But it is nonetheless something to consider, that in a world of, is actually US exceptionalism just exceptionalism in the context of QE? Take that away, actually, your multiple needs to sort of come back to earth a little bit. So maybe that's where money goes.
Right. So as you think about it too, you talked about the pro-value versus like kind of pro-cyclical growth component in the US. Isn't a lot of the international community, or the non-US, I'm sitting here as a biased American saying international, the non-US community, isn't a lot of it more pro-value trades as well? Isn't that part of some of the exceptionalism? And so does that augur well for your thesis here? Or is it just the thesis on value is more of a US phenomenon because of the multiples? Or is this really the broader thematic trade globally?
I think it's the trade globally. I mean, US versus non-US is effectively a growth versus value battlefront, and has been for an extremely long time. And that, you could also, look, it's not just, binary, one versus the other. There's clearly many shades of gray embedded within these markets. You've had plenty of tech stories around the world, obviously in Asia in particular. You've got the luxury goods sector in Europe, which has effectively almost been a quasi-tech play from a European perspective, and so on and so forth. But yeah, essentially that is it. And a lot of that is, at the center of that debate is, once again, the rates narrative. You guys are the experts here. Is really the key to solving this conundrum about value versus growth. Is it hidden more in the non-US inflation dynamic? Is it hidden, and it is the key to unlock it in the fact that actually, what if, the BOJ can't hold 25 bips for JGBs in a world where the rest of G10 is tightening aggressively? What if the ECB have got it wrong and they won't over tighten because actually inflation is a lot more endemic than they believe it to be, just in the same way that the Fed made that mistake? I don't know the answers to this, but what I would say is that I suspect that more likely than not, in a world where everyone still expects inflation to subside, there are risks, upside inflation risks, which would actually prompt higher yield risks, which in turn would prompt that value trade to continue working, especially in a non-US construct.
Yeah, you mentioned that, and the work we've done, on yields, shockingly, we look at yields every once in a while around here. And, the work we do, almost everything says yields should be anywhere between 75 to 125 basis points higher, right? And so, look, the good news is we felt some of that pain. Some of that is the Fed, the QE and the likes, but there's a lot of things that say it should be higher, which could be problematic there. So let me end this on, kind of that value concept. You mentioned it earlier. I want our listeners to get some tidbit of advice, not us just pontificating about how smart we are in real yields and everything. But what is that pocket of value within the US market? What are you recommending for your clients right now on where you think the tilt should be within the portfolio to take advantage of some of that?
So before I say anything, I need to caveat that I am not a member of our research team, and as such, Citi have formal research targets which may not necessarily be fully aligned with these particular views. With that being said, I still think that an area of incredible value is the commodity space. And, I think you can pick your poison here, whether you choose it to be, for example, energy, where, our highly regarded commodity strategist, Ed Morse, is actually quite bearish on crude prices as we move through the course of 2022. And Ed is an absolute stalwart, and he's a legend in the commodity world, and indeed within, in broader Wall Street. And, it would be almost, could it potentially be a repeat of, say, 2008, where baseline prices should have been 75. They went all the way to 150, and then they went all the way back to 35, and then they settled back at 75. So there are definitely you can have these big deviations from fundamental viewpoints. But the way I see commodities broadly is that it sits within the realm of real assets, right? So you've got an inflation hedge embedded right there. But there's something way more interesting within the equity complex on top of that, is that these companies that produce these commodities, and when I'm talking about whether you're talking about copper and aluminium or oil and lithium, it doesn't matter what it is, these cannot be created by two engineers sitting in a garage coming up with a good idea for an app, right? So there's effectively almost an infinite barrier to entry for these real assets. And then you compound on top that the world has been myopically focused on capital light business models for a very long period of time and neglecting those that spend lots of money. And now we're moving to a world where actually shorter duration assets are in vogue, where the cash flows are up front. This is exactly what these kind of businesses offer. And there's something even better than that. Because of the ESG construct over the past half decade plus, most of these companies have had to resort to a much more stringent degree of self-discipline in order to actually fund new projects, because the banks are going to be a lot more reticent to lend to non-ESG compliant businesses. So that means that they've had a lot more capital discipline, which in turn has led to production discipline. So the return profile of these businesses has gone up dramatically. What you're left with is not only businesses that are very strongly pro-value, but you're left with also with businesses that have represented such a tiny weight in the S&P, have declined and declined. I mean, at its low in October of 2020, energy was a 1.8% weight within the S&P. Today, it's a 3.5% weight in the S&P. It's still trading 12% below where it was in January of 2020, pre the onset of the pandemic, despite crude prices being at $90 a barrel, and the return on equity of that sector being at a 7-year high. So to me, there's almost this, you can hear this sucking noise of money that's slowly having to get pulled into this space because of the return profile, because of the dividend, because of the positive beta to rising yields and to inflation. But the best thing about it is there's not enough of them for people to buy, because there hasn't been any new capital deployed there. So there haven't been meaningful new IPOs. There haven't been new shares issued. They've all gone into the new hot tech startup and the new SPAC or whatever it may be. There's very few, should I say,
it's been the other way around. It's been consolidation. It's been BK. It's been just the opposite in that space, right?
Right. So you've had this mystery of disappearing shares in the commodity space, which means that you effectively have, and this is what a piece we wrote in January of 2021. We called it scarcity value in a commoditized world. This upside down world we live in. So 10 years ago, the scarcity value was finding the next big Facebook or whatever it was, the next big tech startup that was going to be the sort of this monopolistic behavior within the tech world, the super app. And then at the time, no one wanted to be involved in commodities because, well, they were commodities, right? Now you've had almost this upside down world where a lot of tech companies have become commoditized because there's no barriers to entry. And yet the commodity companies have, as you say, consolidated, to which now there's very high, dare I say, infinite barriers to entry. So where do you think the real value proposition is? And that's what I think is super interesting about owning commodity equities here. So I'm not going to make specific recommendations to the listeners or watchers. I'm going to let them do their own homework about which poison they want to pick. But I think it's super, super interesting. And I don't want to make claims about a super cycle, but I would make claims that I think there's a really interesting return on equity rationalization within the space that warrants investigation by listeners.
Yeah, I love it. I love the conviction too behind it, and kudos to your research team. We do follow them on the commodity side, so I do agree with your legendary status you attribute to him. But the one thing is that we're running out of time, Alexander. You know, it's been a great conversation. This is exactly what I think people need to hear in today's market. So we really appreciate you taking the time. However, before we let you go, I need to introduce you to Sam's favorite part of the show. Sam?
And my favorite part of the show is to turn the mute button off before I go. But here we go. So Sherman Says is where I will offer up a series of alternating prompts between you and Jeff, unique to each one of you, to which you'll offer back a top of mind response. We try to keep it concise, but we'll let you freestyle on it. So as the first example, I give it out to Jeff with soft landing.
It's not going to be like Sully, you know, not going to just land that thing in the Hudson. It's going to be bumpy. I wish us all well through it, but unfortunately, I agree with Alti on this. I think QT is a bigger deal than they're making of it. Anytime the bankers tell you don't worry about it, it should be top of your list. So, you know, again, I didn't mean investment bankers, Alti. You're a good dude still. Talking about the central bankers, and there's no shortage of central bank of humility in that side, right? They all have this, you know, hubris that gets to this level of they just think they can engineer it. And so I'll ask you, you know, when's the last time the Feds engineered a soft landing? Okay.
Rhymes with what? Hero?
Yeah. Rhymes with hero, you know, or rhymes with sever, you know, but anyway, so I think it's a challenge.
That's funny you bring up humility and hubris, because they're always talking about it as they're approaching this with a humble attitude, and they're going to be, you know, a lot of humility there, but I somewhat doubt it.
So maybe next time they go into the Ecclesi's building, I can never say it right, you know, when they meet, maybe they should put on a little Kendrick Lamar and tell themselves to be humble.
That's right. All right, so that was not concise, Alti, but you see, you get the picture now. So I'm going to hit you with the next one, SPACs.
Interesting investment concept. Suboptimal way to go public.
All right, back to you, Sherman, with fossil fuels.
Is that a suboptimal public acquisition company? Is that what SPAC stands for? No. Necessary evil.
Back to you, Alti, with, let's see here. How about share buybacks?
Makes sense in bear markets.
How come there's no share buybacks in bear markets? You know, whatever, it's Warren Buffett's the only one that buys the stock back in a bear market, it seems like, right?
Yeah, like, I mean, we did, this is not a short enough answer, but we did a lot of work on this, and actually the deliverable alpha of companies who do share buybacks over the recent years has been zero beyond what the actual equity share count reduction has been. So if you buy 5% of your company back, you'll deliver around about 5% marginal improvement in returns, give or take. But where they actually meaningfully delivered outperformance actually was in material market declines, and they actually sort of cushioned that blow. Bearing in mind, 70% of buybacks are done through 10b-18 programs, so they can only sit on the bid, and then 30% is done by accelerated share repurchases. That's when obviously they do, you know, sort of option programs with the bank. No, I look, buybacks. Can I change my answer?
Yes.
Yeah. Sorry. I'm going to change my answer to helpful, overly scrutinized, and please ignore blackout periods because they don't mean anything.
All right.
I think you're the first guest to change their answer, but I like it. I thought it was concise, so I like it. Yeah. No, it's good. I mean, get it on tape. It's going to be live in the annals of the internet for the rest of our lives. So,
what could possibly go wrong?
Yeah.
All right, back to you, Jeff. I think, yeah, back to you with diplomacy.
Hope. Hopeful. Hopeful, I guess, is the better word, but yeah.
Prevents wars.
Yeah, I think bull markets are built on diplomacy and bear markets are not.
All right, back to you, Alti, with flight to safety asset.
Don't forget about gold.
It's been there recently.
Yeah.
It's had a bid recently.
Yep.
Yeah.
I was, I'm not supposed to answer your question, but I was actually going to say cash. And a lot of people would say, really, in a in this inflationary environment. And it's like, well, if you have views that things are going to correct, just you got to have a stop loss on your cash too. At some point, you got to go back in,
Yep.
Redeploy. All right, I'm going to give you another one then, Sherman, since you decided to answer that as well with rent.
It's too damn high. We know that it's too damn high, and it's getting higher. And look, from what I'm reading in some of these headlines too, it's more hyper competitive than actually the real estate market for purchases. So, that is a big problem for the inflationary environment right now.
All right, Alti with Fed asset sales.
Touch on this. Bad.
All right, final round. Sherman, yours is momentum.
It's good. Momentum, it cuts both ways. It's one of the factors out there, and it's one of the strongest ones through cycles. So don't ignore it. Don't ignore it.
All right, and then the final one to wrap us all up, Alti, bring us home with stock picking.
Coming back into fashion.
All right.
Yeah. Bringing stock picking back, well, I won't sing like Justin Timberlake. I'm not even close. I'll just embarrass myself. So, hey,
it's true though. It's true. And it really, I think we are entering a regime. It's not so much that you can ignore macro. Quite the opposite. If you look at macro contribution to stock returns, it's still extremely high. But there has been an increased creep of idiosyncratic and stylistic contribution. And so, getting your stock picks right, or not necessarily stock picks, but sector picks, I think is going to be super, super, super important going forward. Look, I could be way off the mark with, my sort of cautious view on the S&P this year, or at the very least, where the S&P is probably not going to do very much. But I think you're going to see a profound amount of dispersion in terms of sector contributions. We already have arguably seen it this year, right? But I think that we will continue to see it aggressively, regardless of whether you get mean reversion from the sector leadership we've seen so far year to date, or whether we see a continuation of the aforementioned buzzword of momentum. Don't underestimate momentum. Definitely don't underestimate the power of sector picking, because I think it's profoundly important, especially if we stay in this high inflation regime.
Couldn't agree more. So thank you today for all the time. Before we have you go, I know I said the last was Sam's favorite part of the show, but can you tell our listeners where they can get access to your thinking? How can they get in touch with you to get the great research you put out every single day?
Oh, it's pretty simple. If you're a client of Citigroup Global Markets, then you can get access to Citi Velocity, citivelocity.com. You can subscribe to all of my content and my team's content, Citi Equity Trading Strategy, via there through Citi Velocity. So if you don't have access and you do have a research or sales contact at Citigroup, then please do reach out to them, get yourself access. And once you've done that, you can either use the portal or you can receive our material direct to your inbox from me, including a end of day, which I have to write imminently. Yeah.
And we look forward to reading it today. So keep up the great work. We really appreciate it. And you know what? Let's not wait 5 years. Let's do another recap sooner, and then let's go back and see how bad we were with all of our forecasts. So I really appreciate it. It was awesome. This was a great show today. Hopefully our listeners feel the same. Remember, you can follow us on the Twitter at Sherman Show Pod. Sam has been cheating on me as we found out over the last year. He's got another podcast where he puts that on the Twitter as well. D-Line Minutes is the handle for that one. It's called DoubleLine Monday Morning Minutes. So even though he's two-timing me, I'm still loyal to him on this one as well. And so you can catch out all our views. You can also get this on our YouTube channel, youtube.com/DoubleLine Capital, all one word. It's capital as in money, not as in a building. So that's capital with an A at the end of it. AL, not at the very end of it. So DoubleLine Capital. So again, thanks everyone for listening. We'll be back in a couple weeks with another guest. Maybe not as entertaining as Alti, but a new guest nonetheless. Thanks again, Alex.
Thanks, guys.
All right, take care.